Well, the stage is set now for the Fed, as the Fed has now told us to expect a surge in household wages any minute now. Brace for it. But, you know, remember this. When cheap oil, strong dollar, what I call backward prosperity, didn't unleash those animal spirits. So the point is, at some point, higher wages must kick in if we're going to have real economic growth. Now, we do know that wages climbed 5.2%, 56,500, 2014 to 2015, but we're still way below the peak set back in 1999. And on that note, I should point out, disposable income has never been higher. People could actually go out and spend that extra cash, but savings are so low, many people are reluctant, plus they've lived through the Great Recession. So with all of this in mind, what does the Fed know that we don't, and what happens if borrowing and spending does pick up? Will it justify a higher stock market? Join me now, Erin Gibbs, to discuss. Erin, thanks a lot.
Thank you.
All right, so the Fed painted a rosier picture of the economy than most people, than anybody perhaps on Main Street sees. What are they seeing, particularly when it comes to wages?
So they are seeing wage growth, but their big concern is that we're adding about 180,000 jobs a month, and the unemployment number isn't moving at all, which is unexpected and unusual because it should be going down. So we're looking for more and more people to come to the employment market.
But so many people dropped out of the labor market in the first place, though. So, I mean, that to me seems like a disingenuous or antiquated thing. I like to use the employment to population ratio myself. But having said that, we see now where if the JOLTS number, and near an all-time high, 6 million job openings, all of these things, we should already see a major move in wages. What's going on? Why hasn't that happened?
It's because of the participation rate, and I think that's where we're not seeing these major moves. Is that it's going to have to be until everybody comes back to the employment table, everybody who is either underemployed or who got out of the employment market. Once they're back, that's when we're going to see the push, and that's ultimately why they didn't raise rates in September.
But they're telling the world they see it, though. That is happening right now, that we could expect that, coupled with, I guess, inventory rebuilds and like that. Erin,
it's expected for December. They're saying we're holding off. They're just saying we think it's going to happen, but it's expected.
By the way, if it doesn't happen this December, it may not happen for a long time, because when they change the composition of the Fed, they get rid of a couple of hawks that vote right now. I do want to ask you about these traditional the traditional ways that you used to measure the economy, most economists, right? The Phillips curve. Unemployment rate goes down, inflation goes up. That hasn't happened. What's going on with this particular economy? What's so skewed about this recovery from past recoveries?
So the big answer, the biggest component, is energy. Oil. Oil is trading at a mid-$40s. I mean, that's what you're really seeing. And when you take oil out of the inflation, you do see a slightly more normal types of inflation.
Okay. So before I let you go, everyone wants the big question: will the rally continue?
Yes, absolutely. We see a lot of positives. Not only is the economy getting back slowly, but it is getting better, but we're looking at really good earnings growth. So corporate earnings are expected to really recover for even fourth quarter this year and in next year. So very positive. That combined with the Fed not raising rates, it's a risk-on environment. Market goes up.
All right, Erin Gibbs, thank you very much.